Good morning. It is Thursday, March the 19th. Here is what is on the agenda. The energy war escalates. Oil spikes. The Fed flags inflation risks as the BOJ stands pat with the ECB and the BOE amongst a host of central banks set to weigh in later.
The market focuses on those central bank decisions, but in the meantime, certainly focuses on what is happening in the Persian Gulf, Tom. And this is the picture for Brent right now. We're up by 6%. 113 is the handle on Brent. So we're touching new levels on these oil markets in the current crisis. Euro Stoxx 50 futures down by 1.7%, looking to catch up with the selling on Wall Street of yesterday. And that's why we see S&P futures looking a little more muted. A negative risk sentiment going into the European session. A lot of focus on escalation and what is happening to energy infrastructure in the Middle East. The countdown to the opening trade starts right now.
Good morning. So if it wasn't already obvious, this is an energy war. Yes, the Straits of Hormuz effectively closed, other than for Iranian cargo. Today, we are focused on what's happening in gas. European gas prices spiking right now, up 30%, Anna. We saw the reaction from the Iranians after their major gas field, the beating heart of Iranian gas, was attacked by the Israelis. The Iranians responded by attacking Qatar's LNG facility, which provides and supplies about a fifth of global gas. Extensive damage at Ras Laffan industrial city being reported by the Qataris. This is an energy war, and it brings into question how long this continues. For the markets, when does this get back to normal? We are a long way from that right now.
Yeah, absolutely. And so our focus is on the short term, which we've just illustrated with the oil price going higher, the gas price jumping 31% in just this morning's session, as you say. But it's also on the medium term. I know you've been looking at this as well, Tom. Bloomberg Intelligence, for example, saying that if we'll see the extent of the damage at the LNG plant in Qatar. They're talking about extensive damage. They have contained the fires. But Bloomberg Economics and Bloomberg Intelligence saying that this could be several months, even if the fighting stopped tomorrow, which is not likely to. This would still be several months to get back up to full capacity from this particular energy plant.
That is what's so key for the markets. Every time we speak to guests about this, about the market reaction, about the inflation reaction, about the reaction from central banks, it's timing around this conflict. We know now the complexities of reopening the Straits of Hormuz. Now we are getting insights and analysis in terms of how long it will take to revive some of this energy infrastructure in the Middle East. Here's another line coming through then from the Centre on Global Energy Policy, and I'm quoting, "It's now hard to see the Qataris coming back to the market before the middle of the year, and even that is ambitious." And that takes us to the central bank response.
Yeah, it does. And just before we get to that, I mean, I was drawn to what President Trump had to say overnight on social media and how the market seemed to be interpreting it. We've seen the oil price going steadily higher and higher overnight, and we heard from President Trump in the early hours European time, and there did seem to be a way of interpreting this as a de-escalation, but actually maybe the market is much more focused on this as an escalation. He's talking about massively blowing up South Pars, the Iranian field, but only if the Iranians further attack Qatar. So if you take a more de-escalatory approach, you can say, well, this is suggesting there'll be no more attacks on South Pars if Iran does not attack Qatar. But the language being used here, of course, is going to be something that the market focuses in on. And in the meantime, we see this really interesting divergence between what's happening in Brent, what's happening in WTI. We will explore that with our commentators and our guests as we go through the programme. Let's pivot to central banking, because the markets are focused on these central bank conversations, but not because we're expecting many of these central banks to do anything this week. The RBA did, but not many of them are expected to move. And so too with the Fed. We hadn't expected a move and we didn't get one. But the focus was always going to be what lens does the Fed look through when it looks at what's going on in the Middle East? And it was interesting that there were signs of some hawkishness there, perhaps to do with the tariff war as well, suggesting if we don't get the progress on inflation that they are looking for, then you won't get the cuts. And that's what the market seemed to react to, that and the violence in the Middle East. Yeah, I mean,
to your point, they have not even ticked the box yet in terms of inflation prior to the war, and particularly goods inflation, and they raised their forecasts to 2.7%, raising their outlook for inflation to 2.6%, 2.7%, 2.7% for 2026 from 2.4%, and they see core inflation, so ex-energy, rising to 2.7%. The target for the Fed is 2%. And even prior to the war, they're not seeing inflation getting down to that target. Yeah. Jay Powell, to your point, saying, until we see progress on inflation, there will be no additional cuts. The dot plot stayed with one cut priced in, but Jay Powell essentially said, forget about that, ignore that.
Yes.
And then reiterating the uncertainty in terms of what happens as a result. We just do not know in terms of the inflationary impact of what is happening in the Middle East.
Yeah, he said they have very little conviction. So you've got the SEP that was unchanged in terms of those dots, but there's no conviction behind it with some of the language he was using. And it was a really interesting walkthrough of the Fed's thinking, or at least Jay Powell's thinking, and we got confirmation he's going to stay on. Looks as if he could be there a little bit longer, or not confirmation he stays on, but he's not decided. So there's a sense that he could be there a little longer. We'll see how the DOJ probe into the Fed goes, and that's all contingent, of course. But some interesting insights into their thinking, that the fact that inflation has been ahead of target for 5 years or above target for 5 years, that does have a bearing on how they think about inflation, how they therefore need to act. And that there again was another slightly hawkish way of looking at what we got yesterday. And so to the BOJ, where we just seem to get a lot of holding statements about what you can't say yet about inflation, what you can't know yet about the Middle East. And just like lots of central banks, they're really wrestling with this. They're saying, they want to judge the magnitude of the risks by watching the situation.
0.75%. We're seeing live pictures right now, the BOJ governor, as that press conference, of course, continues. They kept rates at 0.75%. The question is the pass-through, of course, given that Japan is so dependent on energy from the Middle East. You obviously start to factor in higher inflation rates in Japan as a result of the energy pass-through, but what that does in terms of dampening growth as well. We have a guest coming up who thinks that they do move with an additional hike in April, but we'll see what Governor Ueda has to say on that. Again, it's a difficult balancing act for the Central Bank of Japan. Beyond and after the BOJ, of course, we get the BOE and we get the ECB. The BOE is not expected to move. That's quite a significant shift from prior to this conflict, when it was almost fully priced that today's meeting would come through with another cut from the Bank of England. That is largely, almost universally, expected not to happen. They're expected to hold, but the wage dynamics are different in the UK. They are softer. This is not a demand-led inflation story. This is a supply-led inflation story. So where does the BOE go from here? We have UK data to fold into this as well before we get onto the ECB.
Yeah, as you were suggesting there, Tom, there is some weakness coming through in the wage story. So November to January wages, excluding bonuses, rising by 3.8% year on year. The estimate there was 4%. So we have some of the heat coming out of the wages story, or continuing to come out of the wages story, which is perhaps a bit of a conundrum then for the Bank of England, because if you've got weakness in the labour market, but you also have inflation dynamics on the horizon building because of what's happening in the Middle East, then that maybe makes your life a little bit more difficult. Having said that, the story more nuanced than just the wages number, because if you look at other measures, the jobs market perhaps faring a little better than expected ahead of the Bank of England meeting. That's certainly the case if you look at the number of some of the hiring stats coming through. But this data just dropping, and the pound not really moving all that much on it. In fact, oscillating around the flat line as a result. It's
worth noting the ECB, in terms of markets pricing, traders boosting ECB rate bets, now pricing in close to 60 basis points of hikes by the year end. Of course, we'll hear from Christine Lagarde later today as well. Rates currently at 2% for the ECB. Let's talk about some of the guests we've got coming up during the programme. We'll be speaking to Patrick Tiernan, the Lloyd's of London CEO. Really interesting to get the perspective of this globally important insurance market, of course, crucial to the shipping industry. What do they make of the latest initiatives out of the United States, and what can we expect from captains in the Gulf of Hormuz? Patrick Armstrong joins us, Plerini Wealth CIO. Great perspective on what's happening in markets right now as we go back to very much focusing on a higher oil, higher gas price this morning. Philippe Aghion will also be with us, co-winner of the 2025 Nobel Prize for Economics. That's a conversation with Fran in Paris, and he, Tom, has been doing research on the links between new technology and making old industries obsolete and all of that dislocation. So that's going to be relevant to the AI conversation. A fascinating conversation, certainly, to stay tuned for as well. Let's look ahead in terms of what else we are watching throughout this Thursday, 12 p.m. UK time. It is the Bank of England's rate decision. That's at 12:30 p.m. UK time. US jobless claims then, in terms of a gauge on the labour market of the US, that's 1:15 p.m. UK time. We'll mark that for you, of course. The team will. The ECB rate decision, and joins Christine Lagarde's press conference. She will be speaking at 8 p.m. UK time. And then we have FedEx earnings. That's after market. Later, Japan's Prime Minister Takaichi, who has warned of and cautioned about a challenging visit to the US, will be visiting the White House. So that is certainly one to watch, as well as she meets, of course, with President Trump expected at the White House. Here's what else you need to know this morning. Copper erasing all its gains this year, falling to the lowest level since December. The metal started this year in bullish form and reached an all-time high in late January, but it shed more than 8% this month alone as traders weigh the potential for supply disruptions from the Iran war. Micron shares fell in late trade as it warned of heavy investment to meet demand, with capital spending this year exceeding $25 billion. The company and other memory chip makers have benefited from an unprecedented data center build-out, which has fueled demand for memory. Micron says third quarter revenue will be around $34 billion, which is above analyst estimates. And Bloomberg has learned HSBC is weighing deep job cuts over the coming years as CEO George El-Hedary bets on AI to shrink its middle and back offices. One source says the changes could ultimately impact 20,000 jobs, or about 10% of its global workforce. El-Hedary has been carrying out a radical restructuring of the lender since taking the helm in 2024, cutting thousands of jobs, selling some businesses, merging and closing others. 20,000 jobs potentially on the lines. They haven't made any decisions yet, but this is a plan that they're starting to weigh up. Again, middle and back offices and AI taking over some of those roles.
Yeah, absolutely. So once again, we're back to the start of the year conversation around the jobs that AI will replace, and maybe some of them are more obvious in retail banking than they had been in other areas, other white-collar jobs. Let's join the dots, I suppose, a little bit between what we're hearing from Micron and HSBC. Yeah. It seems interesting to me that we are worrying at the same time that we're paying too much for AI technology. That's the Micron story. Investing too much, CapEx, is a concern for that sector. And at the same time, we're worrying that AI is going to be so effective, it's going to take away loads of jobs. It does make sense that you can worry about those together. I was thinking back to 2000 when we could see the potential of the internet. We knew it was going to be a game changer, but we were still worrying we were paying too much for the technology, and we all know what happened after that. I'm not sure the parallels are extensive, but I think it's interesting to think about how we're worrying from both directions about this AI story.
Well, many people are drawing those parallels to 2000, so there are some linkages there. Interestingly, just in terms of the earnings for Micron, I mean, they knocked it out of the park.
Absolutely.
Revenues for the quarter coming in above estimates, profits beating, and for the forecast quarter as well, coming in well above the estimates in terms of revenues and profits. So this is a company that's performing very, very well on the higher prices around memory, but they are going to have to commit to that spend to actually meet the demand that they're seeing. Yeah,
beating in so many different ways, and EPS growing by, I think, more than 600%, six-fold increase in EPS, which are incredible numbers. But yeah, CapEx is the concern. Coming up on the programme, there are other central banks that we have not yet talked about, believe it or not, and they are making decisions today. So the SNB is one of those. It's set to make its latest rate decision this morning, with attention centred on the strong franc and any commentary around potential FX intervention. We'll bring you the details of that. That's in over an hour's time. Plus, divisions running deep among EU leaders on a response to the Iran war. We'll go live to Brussels and hear what's on the agenda at a crucial summit today. We next will be talking to Jennifer McKeown, who is Chief Global Economist at Capital Economics. We will get her hot off the press take on what she made of the Fed last night, what's at stake with the Bank of England, the ECB, the BOJ ongoing, of course. If you have questions, please get involved in all of these conversations. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade, Thursday the 19th of March, and we are 17 minutes past 7 here in London, getting a better sense of where we are going to open at the start of the European trading session, and firmly in the red is the answer to that question. So Euro Stoxx 50 futures down by 1.5%. We've seen gas prices jumping again this morning. It seems as if stocks maybe had seen that coming, though, because we were down a little more than this in terms of the futures picture just an hour ago. We do have some catching up to do with the negative session on Wall Street yesterday, and all all of this comes down to the latest developments in the Middle East. So let's get an update on that. Oil prices have spiked, gas prices jumping after attacks on some of the Middle East's most important energy facilities. Qatar's Ras Laffan industrial city, which houses the world's largest LNG export plant, has suffered extensive damage from an Iranian strike. Earlier, Israel hit Iran's key South Pars gas field. We're joined now by Bloomberg's Jumana Basechi, who is in Dubai. Jumana, what more can you tell us about these strikes and the response that we're seeing from Gulf states?
Well, it is day 20 of this war, Anna, and once again, a major escalation, this time in the energy space. Now, yesterday afternoon, Israel conducted airstrikes on Iran's main gas facility, that is the South Pars gas field. And on response to that, the Iranians said that they would be retaliating, but against Gulf states. The retaliation came overnight. We woke up this morning to news that they had successfully targeted the Ras Laffan Qatar facility. And the reason I say successfully is because they had attempted in the early days of the war, in which is, we led Qatar Energy to declare that force majeure with some of its customers. But yesterday evening, while Qatar managed to successfully intercept 4 incoming ballistic missiles, one of them did manage to penetrate and to cause, quote, extensive damage. This is per a press release that was put out by Qatar Energies. And that word, that description, extensive damage, is what is impacting global markets today. And clearly, this is one of the most important consequential export facilities in the world, which accounts for about 20% of the world's supply of LNG. The market now has to account for not just disruption of these supplies, but even possible destruction in the months ahead. But Iran's response wasn't just constrained to Qatar. They also went after some gas fields in the UAE as well. 2 of them were targeted, and furthermore, they also managed to target some refineries very close to Riyadh too. So the response from the Gulf states in the last 24 hours has been one of extreme anger. The Qataris put out 2 statements from the Ministry of Foreign Affairs saying that a line had been crossed, that this was a flagrant attack on their sovereignty, and that they're calling on all heads for de-escalation. The Saudis went one step further and said that their patience is being tested, and that they could respond either via political or non-political means. And you can take that any way you want, but essentially the feeling here on the ground is that these Gulf states have been pulled into a war that they didn't start, and now they are bearing the price, a very heavy price, of the consequences of this war really expanding into different arenas, and particularly in their upstream facilities.
Jumana, thank you very much indeed for that. Again, important update, of course, out of the region. Jumana Basechi on the ground for us in Dubai. For more on the economic impacts, let's bring Jennifer McEwen, Chief Global Economist at Capital Economics. Jennifer, good morning. It seems like the time frame and the timeline is being pushed out in terms of how you get energy back onto the markets. There are expectations. There's some analysis out there suggesting that even getting Qatar's gas fields back will be a 3-month, potentially 6-month process. Getting the Straits of Hormuz back and operating, if there are mines in there, could be a months-long process. We have pushed back the time frame, it seems. Does it mean we start to now price in materially higher inflation?
Possibly. Well, there's obviously still a great deal of uncertainty about just how extensive the damage that has been, and how long it will be before we get kind of LNG supplies back on stream. But what we're seeing now is we were in a situation that looked a bit better than 2022 in that the disruption to gas supplies had been assumed to be temporary. Now, perhaps we're moving to a more adverse scenario where we're going to see much sharper increases in wholesale gas prices. That starts to affect particularly Europe much more. So I think we are in a situation where the economic effects are beginning to look more adverse. But as I said, it really depends on just how extensive that damage is.
Jay Powell, in the Fed press conference yesterday, stressed the uncertainty as a result of what's happening in the Middle East. Very, very difficult to call the inflationary impact, was his take. Was your sense that this was a Fed that was edging towards more hawkish in terms of how it's thinking about the inflationary impact? They're not even done with goods inflation yet, and that was prior to the inflation coming through from energy costs. What was your key kind of takeaway from the Fed?
Yeah, well, 2 things really. One, it wasn't quite as hawkish as it might have been. It's interesting that there's still 1 interest rate cuts in the dot plots in the median forecast.
Is that significant though? He kind of said Ignore it.
We have no idea. I mean, it's sort of what he said.
I mean, and that's true. But if they felt really, really concerned, then surely you would have seen that go. I think they're still hoping to be able to look through it. The fact that he even used the words "look through" in the statement it is interesting. He said that that's the usual playbook, which it should be for a pure supply shock. But the question really is how long this supply shock lasts. And if a pure supply shock, in theory, should be something central banks look through, shouldn't impact underlying inflation. But if it lasts for a really long time, then it does start to drive up inflation expectations. And you do start to see impacts on wage growth, to which a central bank then does need to respond. So I think it really is going to depend on how the situation unfolds, obviously. And it's interesting from the US's perspective, as you mentioned, that the Fed's clearly still focused on tariffs. It was expecting to be focusing on tariffs and how much the pass-through was going to be seen in the inflation data, and that is starting to come through. So there are kind of two inflationary risks there that the Fed needs.
It's interesting. Yes, I hear what you're saying about the SEP, and it was unchanged, even with low conviction, I think he said. But in terms of that conversation about looking through oil price shocks or looking through energy price shocks, he did put that very much in the context of inflation having been above target for 5 years, didn't he? I wonder if you read anything into that, Jennifer. He said that we've seen this repeated set of things. It's the kind of thing that can trouble inflation expectations, as if the longer we are above the target, the longer inflation is above the target, the more worried we are about that stickiness.
Yeah, that's right. And absolutely, from a central bank's perspective, the way that you interpret this kind of a shock that could be temporary it is via the backdrop, the economic backdrop that you're seeing. But from the US perspective, there are two different things. Yes, you've got inflation still high, clearly quite sticky because it has been too high for quite a while now. But on the other hand, you do have a softening labour market to consider. The fact that non-farm payrolls fell in February is still a concern for the Fed. So you don't want to respond too hastily and end up damaging the economy.
Yeah, I wonder what your take is on the UK at that moment, with the same context in mind, weakness in the labour market. I mean, we've got wages, some of the heat coming out of the wages story, it seems. We've got an unemployment rate of 5.2%, a little weaker, but, a lot of doubts about that data set. I wonder what you're seeing in the labour market and how that plays into the Bank of England, which we're waiting for today.
Yeah, that's really important, and we have been seeing significant weakness in the UK labour market, more so than in the US. And we had anticipated that was going to lead to a pretty sharp decline in wage growth, and that would allow the Bank of England to cut all the way to 3% over the next year. However, we now have wage growth, yes, coming down, but still too high. 3.8%, that's too high for the Bank of England's comfort. So we would need to see it coming down further. And I think this additional inflation risk of higher energy prices is going to be a real concern for the Bank of England, more so than for the Fed, given that's the starting
Just
point.
very briefly, from the BOA to the ECB, traders pricing in more rate hikes this year from the ECB. Is that the way to be thinking about it? Is the ECB more likely to hike maybe than the BOE? Just briefly.
I would say equally likely. I think it certainly is worth thinking about the risk at this point, particularly now that we're starting to see infrastructure seriously damaged and an impact on gas prices, which is really, really important and is what really drove inflation up in 2022. At the moment, we're not expecting ECB rate hikes, but it depends very much on how long this goes on.
OK, thanks very much, Jennifer McKeown, Chief Global Economist at Capital Economics. Thank you very much for your views on all that has happened geopolitically and what that means for various central banks around the world. Coming up, as shipping insurance costs soar, we will speak exclusively with the CEO of Lloyd's of London, the world's most important insurance marketplace. That interview is coming up next. This is Bloomberg. Welcome, everybody. This is the opening trade Thursday morning. The futures picture looks pretty grim if you're long of these markets for European stocks. US stocks, of course, lost more ground yesterday as we saw an intensification of the fighting hitting energy infrastructure in the Gulf, in the Persian Gulf. And as a result of that, stocks were weaker stateside yesterday. We need to catch up with that. We've also seen a really big spike in gas prices this morning, up by 23% on the Dutch benchmark. We're up by 5% on Brent. So let's just show you what's going on across that complex. There's the European gas futures at the bottom of the screen there. And here we just flag that divergence we're seeing. And it seems the first day that this is really obvious, that Brent crude is really responding, up by 5.6%, continued attacks on infrastructure in the Gulf. But New York crude, so WTI, is pretty flat. And increasingly, Tom, we're going to pick up on this later in the programme, but we're thinking about the way that these contracts might diverge.
All of this, of course, is tying in, as you look at gas prices as well, up about 20% in the session today. All of this is tying into how the bond market is reacting. So let's flip the board and have a look at the sell-off that we're seeing. Yields higher across the European space, of course. Expectations. Traders now pricing in potentially 2 interest rate hikes from the ECB by the end of this year. More than 50 basis points currently being priced in by the markets. So yields up, bonds selling off. And you're looking at the benchmark 10-year over in Germany, 297, closing in on 3%. Yields are up 3 basis points, but there's more pain at the front end with the 2-year at 250 right now. Yields up 6 basis points. Over in Italy, BTP is also selling off. Yields up about 5 to 6 basis points. And you're seeing a similar picture as well over in France. The OATs, the benchmark 10-year at 364, yields up 4 basis points. But again, it's the front end that's seeing more selling pressure. So we continue to monitor this dynamic, but certainly the bond markets are reacting, as they have done during this conflict, and yields are higher.
Yeah, yields were up yesterday as well, weren't they? So another day of that. Now, as the Iran war shows no sign of easing, the cost of insuring vessels to sail through the Strait of Hormuz continues to rise. One of the world's biggest insurance marketplaces, Lloyd's of London, reporting results this morning for 2025. Pre-tax profits coming in at £10.6 billion. We're joined now by the CEO, Patrick Tiernan, and it's great to see you. Thank you very much for coming to speak to us. So there's so much to talk to you about, and I know that insuring shipping is something you do that has great global importance, great deal of focus. It is only a small part of the Lloyd's market, and there's a broader story. We'll come to that broader story around pricing, inflation, and all the rest. But if I could just get your up-to-date take on what we're seeing in the Straits of Hormuz, because for some time people were asking, is it insurable? The message out of Lloyd's and others has been, yes, there is insurance provision. It's more expensive than it was. So give us the up-to-date take on how insurance is performing in that particular part of the world.
Yeah, thank you. So you're right. The insurance market does continue to remain open and is continuing to quote for risks, both for static vessels and for vessels who have taken the decision to transit the Strait of Hormuz. That is pretty rare at the moment because people are focused on safety and security. But the insurance market does continue to trade through this. From Lloyd's perspective, we run a market, so it's really important that we actually ensure that the market continues to respond and continues to feel the support that it can trade through these conditions. And Lloyd's has been doing this for 337 years. So we have a level of expertise and a level of learned muscle memory from actually trading through crises like this, going all the way back to the end of the Iran-Iraq war.
Yes, there are lots of people trying to work out how we get more traffic through the Strait of Hormuz. Yeah. The US government has come up with a plan that involves providing its own insurance. Yeah. What are conversations with them like? Do you think there is a role for them in this market?
So I think one of the really important things when you're running a market like Lloyd's of London is to ensure that people can talk to us and get our expertise in a discreet way, so they actually understand that the conversations with us are private. So we do continue to work with the UK government and international partners for all of the pinch points, anywhere there is a need for capacity or expertise or solutions in place. So I think it's always welcome when you have smart, intelligent people, new capital coming into these situations, and that's where we're focused.
So there is a role for governments in this, then, because there's another argument that says, look, the private sector is handling this, and it's not a lack of insurance that stops the ships going through. So
I think we've seen from past crises, from a terrorism perspective, you have the government involved in Pool Re here, TRIA in the US, in flood you have government-supported programs in place. So there is a role for the public and private sector to work together. I think making sure that we're complementing each other, so we're both working towards the same solution. So aligning interest is really important, and that's where I think Lloyd's can play a good role. We do try and make sure that we have our conversations in private, so you actually have practical solutions coming forward.
What does ILSOL do, Patrick, good morning, to pricing? Prior to the war, we were looking at pricing about 0.5% of the value of the vessel. Now we're looking at quotes, sometimes 3% of the value, sometimes 7% of the value. Do you expect pricing to continue to rise as this conflict seems to escalate?
Yeah, so there's probably quite a few different covers, different classes of business in place for this crisis. Yeah. So the one we're all talking about is war risk insurance for marine. But there is aviation, political violence, terror, cyber, all of these different classes trading, and they have different dynamics. So within maritime war risk, there is more real-time pricing, there is dynamic pricing. Other contracts are longer. So we do expect the underwriters, the brokers, and the clients involved to actually trade around the risk dynamics that are current, and you may see spikes and you may see prices drop off pretty quickly. I think it's important to remember that for those war risk prices, the prices are actually low during times of peacetime where there isn't a crisis. So they do have that spiked tendency in times where there's more risk and more activity. I think in the wider pricing picture in insurance is slightly different, actually. This is a relatively small part of the insurance market. If you sort of bring the lens out, we're actually seeing more pressure on prices, actually, in other areas of the market.
We want to get your take on that, but one last one on what's happening in the Middle East. If this conflict extends for another 30 to 60 days, your market can absorb that.
Yeah. So actually, if I link everything back today, so talking about the results from 2025, but actually more importantly, the very strong balance sheet that we have in place, it's actually having the capital to sustain the provision of insurance through these crises. That's really important, to be able to be the shock absorber when you have significant risk and possibly significant claims coming through. So making sure that we have that solidity, very important, because it allows you to stay in the game for a bit longer.
So Patrick, is it not a lack of insurance that's stopping vessels going through the Strait? It's something else?
Well, I think there's a number of vectors in place. There's security vectors, there's diplomatic vectors, and the government has roles to play there. When it comes to insurance, what's critical is that we keep the market open, we keep talking so that these solutions can be in place, so that insurance is not an inhibitor.
Yeah. So thinking about pricing and making this a bigger picture conversation, it's difficult, I suppose, from your perspective you have a lot of things to make assumptions on when you're quoting prices. Inflation is one of those, and we're in an environment where inflation expectations are shifting quite rapidly. Gas prices jumping again this morning. Talk of gas fields being out for months rather than just days. Yes. How do you make assumptions around inflation in such a fast-moving environment?
Honestly, it's probably one of the most important things that we monitor from a market perspective, because inflation, with its longer tail, actually stays within the liability side of the balance sheet longer. So we always have to keep a weathered eye on inflation. I think today we talk about our investment return and the capital that backs the insurance liabilities within the market is actually it has a relatively low risk. It's in sort of government bonds. It's in very highly rated corporate bonds. So actually, the portfolio is pretty well placed for these shocks, which is good, and it always keeps coming back to that. In order to have a strategy, in order to be financially relevant, we must ensure that we have that extremely strong fortress balance sheet. Yeah. And in Lloyd's, it is actually one of the best kept secrets in the financial world, that financial strength, that capital strength that we have.
That fortress balance sheet, and that increased again, didn't it, in 2025? The results show that, Patrick. Look, you mentioned that we carve out maritime for the moment and that space, but you mentioned that beyond that, prices are actually going down. Yeah. What is driving the downward pressure on prices, and what does that mean for your business?
Yeah. So we've had 7 years of continuous price increasing broadly across the insurance space, and that has resulted in increased profits and increased that capital has got to find somewhere to go. What we're seeing now is a moderation of prices, particularly driven from US property, which is a third of the business within the Lloyd's market. Property is a very dominant category. So while we report very strong underwriting today, 87.6% combined ratio, which is very strong, we are seeing erosion of price and erosion around the margin. So it's absolutely critical from a market perspective. We keep the discipline in place. We keep folks very focused on ensuring that we don't give away the solidity of the underwriting that's been built over a couple of years.
Yeah, and Patrick, you've set out today a new strategy going out 5 years.
Yes.
We've already talked about how difficult it is to make assumptions around inflation right now. Plenty of other variables, including some really big sort of tectonic plate thematic things that are happening around climate change and the like. So what are the linchpins of this five-year strategy? What are the assumptions that you have to make about the way that the market is going to evolve?
So the linchpin is sharpening our financial edge, making sure that all of our decisions come down to ensuring the financial strength and improved returns. And one of the secret strengths of Lloyd's is its capital advantage it has. We can, as a market, we can shoulder more insurance risk per dollar of capital than any other financial institution around the world. So we've got to deploy it for the risks that are coming. I think as we follow the real economy, as we follow where the dollars are going in the real economy, in defence, in energy security, infrastructure, some of those all coming together in the very large data centre projects, we need to make sure we're risk on, that we can stay relevant, stay proximate, and be involved in that innovation. And in a market, you have the underwriting expertise, you've got the capital advantage, and you've got all the connections. You bring that together, and we can actually have systemic growth forward for the industry. So that's why we want to keep it financially focused.
Patrick, when I think of efficiency, I think now of AI, and we think of the story around HSBC today, potentially looking to cut 20,000 jobs over a time frame as they embed AI. In 5 years' time, in the Lloyd's of London marketplace, are you going to have more or fewer workers?
So I think that is a prediction I'm not going to make today, but I'll tell you what we are doing today. So when it comes to the Lloyd's of London, so we employ 1,200 people around the world. We're actually announcing today that we are doubling our early careers intake, because we actually do need we need bright people to actually help us through the next 5 years.
That's graduate, recent grads?
Yeah. Well, leavers, so they don't have to be. It doesn't have to be grads. So
okay.
You can school leavers or university leavers, but early careers. So we're going to double that by 2027, which I think is pretty important. I think as well, there's a temptation to jump to using AI before you've simplified and fixed your own processes. So for the next 2 years, we're going to really focus on decluttering anything that we don't need, so that when we do apply the benefits of AI, do apply the benefits of technology, we apply it onto a very simplified set of processes. And actually, we're working pretty well with the UK government and regulators to do that.
Patrick, thank you very much indeed.
Thank you.
Really appreciate you coming to the studio with that update and, of course, your views of what's happening in terms of maritime insurance as well. Patrick Tiernan, CEO, of course, of Lloyd's of London. Now, analysts are warning of the wide-ranging impact, of course, that the energy shock will have on the global economy. Take a listen.
The type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table.
Jeff Curry, Carlisle Chief Energy Strategist, speaking to Bloomberg. We're going to discuss more on the oil crunch and the implications, of course, throughout the show. Stay with us. This is Bloomberg.
We're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. The rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut. This is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. I have no intention of leaving the board until the investigation is well and truly over with transparency and finality.
That was the Fed chair, of course, Jerome Powell, speaking on the occasion of their Fed rate decision. Joining us now to talk about the markets in more detail, our Markets Live executive editor, Mark Cudmore. Mark, let's start with what we're seeing in energy markets, because are you sensing that with Brent at 114, sure, WTI looks fairly restrained, but Brent at 114, gas prices jumping 24% in just this morning, are you sensing that we're about to take a step change into new territory in terms of people's expectations, assumptions about how elevated energy prices are over the first and second quarter of this year?
I think that's absolutely what's playing out right now, Anna. And I think the way this is kind of transpiring is probably the trajectory for the next couple of weeks, in terms of that we'll go through periods of trying to be in denial or being optimistic and then have step shifts lower until we have clarity about the strait being, sustainably opened. And I just don't see how that clarity comes anytime soon. So I think what people are really starting to get, suddenly get kind of grasp, is that the impact on some of the derivative oil products, whether it's other commodities or whether it's natural gas or whether it's, things like helium and fertilizer or whether it's jet fuel or shipping fuel, they're realizing that, there's a lot of industries that are going to be particularly badly targeted. What we're seeing in oil markets today is quite extraordinary, because WTI, when I walked down to the studio, was pretty much flat for the day, and yet we're seeing Brent really surge higher. So that spread is absolutely blowing out at the moment, and I think it's really problematic for specific economies, specific sectors, apart from the broader wealth destruction we're seeing.
Mark, what did you make of how Jay Powell responded to this conflict, the inflationary impacts, and how it kind of feeds into the Fed's thinking? What was the key line that stood out to you from yesterday?
I think the two big takeaways were that two of the previous dissenters no longer dissented, which made sense, so slightly hawkish the margin. And Powell saying he'd stay till the investigation is over, not guiding on longer. But the idea is that he might be around for quite a while. So, the Fed could never say anything useful about the conflict because no one really has a clue on the trajectory. And we don't, therefore, if it ends... If in the optimistic scenario, which I don't believe, that it ends imminently and oil prices collapse, well, then they can kind of ignore all this shock. But, as it goes further, we have a stagflationary impulse. We do have both inflation and demand destruction, and which matters more will depend on the extent of that energy surge and how long it lasts. So for me, it was the other points to take away. It was a marginally hawkish meeting, but, it's completely overshadowed by what's happening in the Middle East.
And what are you watching for the rest of the day, Mark? Because there is a lot going on, certainly in terms of central bank decisions, but and headline risk around the Middle East, of course, is on our list.
Yeah, we have a load of central banks and, a short-term watching out for the guidance of how they all speak about this. But we know, again, that like the Fed, there's not much they can do yet. This is a major problem brewing from them, but which way they're going to react will depend on the duration, which just sounds like such an annoying phase because it's so overused at the moment. It depends on the duration of the conflict. So I think the central banks won't really matter. I'm interested in the price action and do equities start pricing in more of the damage that's caused from energy markets and related commodity markets? Because I still think there's a lot more downside in equity markets, despite it already being the worst month for global stocks in 3.5 years, as we talked about before.
Bloomberg Markets Live executive editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis and insight, of course, from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get you your stocks to watch then on a broad down day for these markets and bring in Charlie Wells. Charlie.
Good morning, Tom. So really, energy is top of mind this morning as analysts start to parse dislocations that may be coming from some of these big movements in energy. We had that attack on the world's largest LNG export plant in Qatar. We've seen Trump try to de-escalate the crisis, particularly as it involves these energy facilities. So we're screening for differences here. We can see over the past month, these European major energy companies up, of course, but up by different amounts. We've got Shell up over 17% 2% on the month. We know they have a lot of LNG. Total, a lot of exposure to the Middle East. Different story for Equinor, up by the most here. They are not exposed in the Middle East. And then I also want to bring up Eni, because we had that report from the Italian government lowering taxes on petrol. So again, how that spills through these energy firms. I want to stay on the crisis, but I want to flip to consumer staples, because we've got some interesting analysis coming talking about consumer staples. I have been talking to analysts all week about this issue of stagflation. What tends to perform well in a stagflationary environment? Consumer staples, because people are still going to buy chocolate, they're still going to buy yogurt, they're still going to buy a lot of these, personal care products. These are down right now, but analysts are starting to have some interesting takes here. I've got Laurent Perrier here as well. It is a champagne company, definitely not a staple, but it connects to a point that Camilla Anderson, a fund manager at a top European equities fund, talked about, that they are seeing some opportunities, maybe some noise getting in the way of some of the fundamentals here. So again, important point to remember. Let's end with HSBC. They have that headline about these job cuts, potential job cuts, possibly related to AI. Taking a look at their performance, they've, compared to European stocks, had been underperforming, a big jump. Let's see how the market interprets that job cut news today.
Thanks very much, Charlie. Charlie Wells with some of the stocks and sectors that could be on the move, and some really interesting analysis there pulled out from some analysts, Tom, around staples. Interesting that food, beverage and tobacco, consumer discretionary, grocery stores, those defensive sectors, the worst performing in yesterday's session.
Yeah.
So we'll see if there is room for a turnaround.
Yeah, it's a sector down more than 2% by the close yesterday, the food and beverage sector. We have a reminder, and Charlie was talking about HSBC, the potential AI job cuts, which you've linked, of course, in terms of what's happening in terms of the capex spend as well on AI. We had Micron coming through with a view on 25 billion, and then Samsung essentially saying, hold that thought, because we're looking at 73 billion, about the equivalent of $73 billion worth of capex to build out for this demand they're seeing for memory.
So that keeps us focused on tech. We'll see how that performs this morning. The futures picture for Europe, though, looks decidedly negative. Focus increasingly, extensively, continuously on what's happening in the Middle East and attacks on energy. This is Bloomberg. Welcome back to the opening trade. A few minutes to go until the start of equity trading for this Thursday morning here in Europe. We need to catch up with what happened in the States yesterday. That's part of the job ahead of us here in Europe. So we saw on the S&P 500 yesterday, after Europe closed, which is where that yellow line is, we saw US stocks trailing off, dropping further. Ongoing tensions in the Middle East, of course, that was really the driver. So as energy prices go higher and continue to do so overnight, much higher on Brent, much higher on gas prices, we are factoring in something quite negative for the start of the trading day. Let's have a look at the futures picture, because, Tom, we do seem to have crossed something of a Rubicon over the last couple of days or so. Energy infrastructure now seems to be fair game to some degree from both sides. President Trump trying to distance himself from what the Israelis have been doing, but there have been attacks from both sides on energy infrastructure, on gas fields, and that is really having an impact on expectations around how quickly anything can be brought back on stream, even if we did see an end to hostilities, which doesn't seem likely.
So we zero in then on the energy space, of course, today, given the price spike that we're seeing in natural gas in Europe, up 24%, and Brent up 6.5%. So energy stocks will be in focus, of course, today on the back of that news. This is now an energy war, it seems, in the Middle East. Chip stocks also in focus. Interesting in terms of the capex spend coming through from Micron, a commitment of 25 billion through this fiscal year, and Samsung coming out in the last couple of minutes committing to more than $70 billion worth of capex spend as well. So we look at the chip stocks in Europe for any reaction to that. HSBC with an announcement or some reporting from Bloomberg suggesting they may cut quite a significant number of jobs, potentially 20,000, as they embed AI, potentially, Anna.
So, Tom, as markets then start to reassess, rethink how elevated energy prices are going to be in the first quarter and remain in the second quarter, what does that do to markets here in Europe, to stock markets here in Europe? We've seen energy stocks performing pretty strongly on days when energy prices have gone higher, and perhaps that is the knee-jerk reaction we see once again today. But at some point, we have to ask questions about demand destruction from higher prices, and so that will no doubt be part of the conversation as we go through this morning as well. So the FTSE 100 100 is out of the gates, and it's decidedly negative, as expected. All of these markets expected to open firmly into negative territory. So we're down by 1% on the FTSE 100. The CAC 40 down by 1.2%. The IBEX down by 1.5%. Looking for the Xetra DAX to open up. The longer these markets take to open up, the less they can rely perhaps on the energy sector to prop them up. The DAX doesn't have much in the way of energy stocks, and so perhaps we'll see a little bit more downside there. But we are seeing negativity not just on the CAC and the IBEX, but also on the FTSE 100 this morning. And I wonder where that energy narrative takes us, Tom, as we see gas prices jumping by more than 20% this morning. Energy is the only sector in positive territory right now, up 0.7%. Basic resources, the biggest pain point across your sectors, falling more than 3%. We've seen pressure on copper, on iron ore, on silver and on gold as well. Basic resources taking a big hit there. That sector down 3%. Travel and leisure falling 1.7%. Banks under pressure. Earlier this week, banks have performed relatively well as a sector. Currently, that sector's down 1.6%. Autos also taking a hit, down 1.5%. Every single sector in negative territory so far in the session, apart from energy, which is up just 0.6%. Worth noting as well that there's a pretty significant sell-off in gilts right now. More significant than we've seen in their European counterparts. That is something we've seen and has echoed since the start of this conflict. Yields are up 10 basis points right now at the front end when it comes to gilts. So selling of the sovereign debt in the UK, gilts yields jumping, price down. Again, across your sectors, it's just energy in positive territory. And basic resources, by far and away the worst performer, down by 3%. We've got Fresnillo as the worst performer within that sector. And interesting to note that gold prices are on the back foot this morning. Silver prices down 5%. Gold prices down by 1.8%. Obviously, when you see other markets quite so risk off, your mind goes to, well, what are investors going to have to sell to meet margin calls? And maybe that's gold, maybe that's the liquidity function that it's providing today, rather than the haven function that it sometimes has provided. So 2 minutes into our session, Tom, let's get a perspective, shall we, on energy stocks. Patrick Plurumi joins us now from Armstrong, of course. Patrick Armstrong, I should say, CIO. I've just merged your name and the title of your house. Patrick Armstrong, CIO at Plurumi Wealth. Patrick, good morning. So you say that the market is probably too pessimistic. The market is probably too pessimistic on inflation over the next year. Really?
Well, if you look at inflation break-evens over 10 years, they're at 2.4%. And that's too complacent about inflation, but inflation break-evens over 1 year are 5% right now. And I don't think we get to that over the next year. I do think we get above 4% in the summer and probably come back down, maybe based on a too optimistic view on the war that it does peter out as we get into the summer. But the cloud of war, fogs of war, you don't know where things are going to go. There's going to be many twists and turns. But 5% break-evens over 1 year does seem very pessimistic about the inflationary outlook.
Do you think equity markets broadly are showing complacency at this point?
Perhaps. They've definitely reacting to the bad news. Stagflationary fears are definitely rising and plausible coming into the year. Didn't look like they were plausible given a very strong consumer. But energy prices choke many things. And a little bit too complacent because the Fed narrative is weakening. You're getting some politicization of the Fed to some extent. I do think Warsh is going to be minded to cut. I probably think he gets appointed. But it's a higher bar now. So Powell's discussions last night, relevant, but not as relevant as they'd typically be because we're going to have a new chairman coming in who is going to be minded to cut. Whereas Powell would probably be minded to hike even as this year progressed, it sounded like. He was more hawkish. I think he thinks we're at neutral. I think Warsh thinks we're at restrictive levels because of AI productivity that's going to be coming in.
Patrick, yes, no doubt. We'll talk about AI and technology in just a moment. Just to linger on the energy theme a little longer. I mean, energy stocks have been this knee-jerk positive when we've seen days where oil prices have gone a lot higher. So Brent's up 6%. Energy stocks are the only sector in positive territory. Does that continue? At some point, do we have to start asking about demand destruction for that particular sector?
You do. If oil prices, I think 100, 110 is the point where it does start to squeeze either profit margins or consumption. It's got a lot of consequences. And I think 80 to 100, the market can shake it off. Sorry, Taylor Swift. But once you are at these levels, and if there is further supply disruptions, you have the risks that it goes higher. You do have to think about the consequences in terms of higher input prices, consumption, and yeah, we're at the levels now where it is starting to hurt.
So you don't think that, you think the market is factoring in too much inflation in the short term then. Is that because, I think you were citing the US there, and is that because the US is a little insulated, and what should we be expecting in the rest of the world?
You've got a very strong dollar right now, which offsets some of it. You've got the US, which is still energy self-sufficient. Oil is a global commodity, so when it rises in Europe and the Middle East, it does go up in the US, but it is self-sufficient there. And 5%, it's just hard to see how we get there, and that's where break-evens are. And I think I'm one of the biggest inflation hawks that I know, but I do think 5% is a little bit over-egged in the short term. But in the long term, people are just way too complacent about it. Populism, nationalism, trade wars, debt-fueled spending, that's going to be very inflationary. So 10-year break-even's way too low. I think the 1-year break-even's a bit high.
Okay, long-term inflation is there, and there's structural reasons for that, is your argument. As you look at your portfolio, Patrick, how are you thinking about timing around this conflict?
It's very difficult, and the winning strategy right now is take a little bit of profits on up days because the next day is down, add on those dips the next day. And we do have a cycle where we've got Trump speaking positively, but then refineries being damaged and back and forth. So Trump definitely doesn't want this to go on any further. Unfortunately, it's not like the taco trade of April on trade war. This is a real war, and you can't pivot from that as quickly because you need Iran to play ball. It's not just Trump's decision. So I think any chance he has to take a win, he'll be looking to do that.
Yeah.
But Iran's not giving him the chance to take that clear win.
So when you take profit and you put that in cash or you put that elsewhere. Where are you looking to deploy that?
I like to sell put options on stocks I'd love to own if we do get to the point where market gets oversold. So you're getting really good vol right now. Implied vols 24, 25%, and it's not even that backwardated, so you can go further out. And if you have a stock you'd love to own, if it was a bit cheaper, you get paid a very nice premium to create that buying discipline. And it's really hard to have that buying discipline because when the market's going down, there's a reason people are scared. But if you find companies with great business models, companies that are going to come through this war, and at the end of this year, you know their business model is going to be sound, that's a winning strategy.
And Patrick, do you find those winners in the AI sphere? Do you find companies that meet your criteria in the tech space right now? How are you thinking about AI?
I love the high bandwidth memory stocks, so Micron, Samsung, Hynix. I do think they are cyclical companies. It's essentially commodities they're producing. But if you're picking them up at less than 10 times forward earnings with the growth they have, I do think we've got a runway of many quarters ahead of us with really strong results.
So the market shouldn't worry quite so much about big capex numbers, do you think?
You have to worry about it, because it is going to happen. I just think it doesn't happen as quickly. It's insatiable demand, and I think that's going to be the story probably for the next 6 to 8 quarters. And it's history always repeats itself. It's like shipping or oil commodities. You do get an overbuild, but the demand is insatiable right now, and they've sold everything they can produce through 2027, even with the capex they're targeting. So I wouldn't be surprised if Micron's up by the end of the day, because when the U.S. retail market opens, investors love high growth. They love being able to pick up a stock less than 10 times earnings. And I do think this is something that has several quarters ahead of us. Maybe not several years, but
where else within the AI ecosystem are you looking in terms of how much conviction do you have that the build out and the capex spend continues, and that the move up the curve in terms of the models and the innovation continues?
I want to own all the companies that are receiving money from the hyperscalers. I think they're 100% committed to their spending. That will change at some point. The market forces will push back on their capex if they're not generating profits. But right now, they're just laser focused. We're spending, we're building our cloud compute, and companies like NVIDIA, Micron, Samsung, they're the beneficiaries of it. I also like electricity generators. Uranium is going to be part of that. So it's clear to me these hyperscalers are going to spend. It's not clear to me they're going to be incredibly profitable. They might be, but I love to own the companies where that spend is going today.
And are you leaning into Asian companies in this space? Because before the Iran war, that seemed to be the big pivot. It was all about Asia hardware versus US software. Where are you on that one now?
So Samsung and Hynix are Asian. It's not that they're a play on Asia, but those are two stocks I think fit in right with Micron. I think they're all very similar companies, business models. They've got an oligopoly and just incredible pricing power.
I've seen some concern being voiced that the money out of the Middle East, the sovereign wealth funds, and the capital that have been pouring in, a lot of it into tech, is going to start to dry up now.
Interesting, yeah.
Is that a factor that we need to start thinking about as they have to prioritise rebuilding their energy infrastructure and other parts of the economies there?
Makes sense to me, actually. I haven't heard it before, but and unfortunately rebuilding energy infrastructure that's being destroyed, things like that too. It's going to be at the margin, though. They're not going to do a 180 pivot away from technology, but you may start to see other aspects being allocated to. And the world, the equity market is very tech-centric. And I think not just Middle Eastern and sovereign wealth funds, but investors as a whole. It is a broad market rally, is what we had before the war. I think we get back to that by the end of the summer, and technology is not the only way to play. We are in an environment where there is still growth. It's a strong job market that's definitely weakening, and I think that sets a tailwind for equities.
What about some of the havens that haven't been quite so haven-like? I mean, gold.
It's not a safe haven anymore. It's a speculative asset. It's
just,
you can't call gold a safe haven given the amount it's run up. It's going to be a source of funds when there is risk aversion. And when there's risk aversion, generally you see yields moving higher. Not usually seeing yields moving higher, but in a stagflation, which is what gold should be a safe haven for, you get higher yields as well. And that's going to be toxic for equities, long duration bonds, and gold, I think. So I do like the gold miners because gold doesn't have to go up for the gold miners to generate incredible profit. But I think gold's a speculative asset, not a safe haven.
That's really interesting. When did gold become a speculative asset?
January.
When the implied volatility on gold got higher than the implied volatility on equity, and that's where we're at right now. So gold implied volatility is at high 20s. Equity volatility is at 26%. So if equities are a speculative asset, gold's more speculative than equities.
Really interesting. Patrick Armstrong, thank you very much indeed. Florimi Wealth CIO. Let's check in on the core six right now. Of course, on another day of pressure across European and global equities. Nestle is down 1% with that focus, of course, on the consumer. Schneider Electric, with that exposure to the data center story, but down 2% in the session today. ASML as well, down 1.7%, not benefiting from the pledges around increased capex coming through from the likes of Samsung and Micron, at least not now. Rheinmetall in the defense space is the only stock in that core six which is gaining today, up 1.7%, as you can see. LVMH in the luxury space. Luxury has been affected, of course, by the war in the Middle East, and that's down 1.4%. And you're seeing Novo as well. Also a little softer by 2, close to 3 points, down 1.1%. Let's check in on some of the other individual stocks on the move this Thursday and bring in Charlie Wells. Charlie.
Good morning, Tom. So we're going to start off with the miners because we are seeing them under pressure this morning. This really is one of the emerging stories that we're starting to see. Rio Tinto, Glencore, and Fresnillo all down significantly this morning. And I think the question here is, are traders starting to interpret some of this negativity, the significant negativity in the Middle East, as a long-term issue, impacting that economy long-term? I think that's one of the key themes we're starting to see this morning in this movement. Let's flip and take a look at Equinor because they are, again, tied to this energy crisis. They are tied to the Middle East conflict, but they are up nearly 5% this morning. Now, this is interesting because this is an energy company that does not have direct exposure to the Middle East. That has been a positive story for the stock over the past few weeks, but they also have some news out today talking about a reorganization, trying to create more value and splitting some units to create more value for shareholders. And at least right now, that is a story that is looking like it's giving a boost to Equinor. Let's flip and take a look at a different European stock. We're thinking about Lanxess. This is the German chemicals company. They are down over 8%, almost 8.5% this morning. Now, we know the chemical sector here in Europe has been under pressure. Europe really is awash in chemicals. There is a lot of kind of supply issues there, but they issued a disappointing earnings report, a forecast that disappointed as well, also talking about job cuts. So not looking great in this sector, but also for Lanxess more specifically. Now, there's another big story that we've been talking about all morning, and we want to watch this. It's HSBC. So people familiar with the matter have said that HSBC is considering significant job cuts as they experiment with gaining more efficiency because of AI. We want to see how this plays out because there's negativity now, but there's a flip story that I think we should watch out throughout the course of the day, which is some investors like the announcement of AI-related job cuts because it means efficiency, because it means companies are spending less on labor. So that is a story to watch out. Not huge moves right now, but let's see if that flips to green or stays in the red throughout the day.
Thanks, Charlie. Charlie Wells with a rundown of some of those movers this morning. Something else, Tom, that's on the move is the gilt market, and we have gilt yields higher across the curve, notably a little higher than the rest of Europe. So if you're looking at the 10-year tenor, we're up by 8 basis points against France and Germany, up by 5 and 3 respectively. If you click into the UK curve, you see we are up by more than that, of course, at the short end. So 2-year yields now up by 11 basis points, this ahead of the Bank of England later.
Traders now pricing in more than one hike from the BOE this year, 36 basis points by December. And that's despite the fact that we had jobs data reminding us that jobs and unemployment remains near 5-year highs here in the UK. So a soft labour market, and yet markets and traders are pricing in closing into two hikes from the BOE.
Yeah, absolutely. So as the wages story, we get some of the heat coming out of that. The rest of the market, labour market story, though, it is possible to tell a bit more of a positive story. The jobs market faring a bit better than had been feared ahead of the Bank of England meeting. But they are still worried broadly about the jobs market, and now they have to worry about the inflation side of things as well. It is 8:16 here in London. Coming up in the programme, we will continue coverage of our HSBC scoop. More on the potential job impact of the bank's bets on AI. That's next. This is Bloomberg. This is the opening trade. Welcome back to the programme, everybody. 19 minutes into our trading day, and there's a lot happening. European equity markets very much on the back foot this morning, down by 1.3% on the stock 600. It's kind of across the board as well. So even the geographies, which are slightly cushioned from the worst of the selling by the fact they have a high representation of energy stocks, not really outperforming much today. So the FTSE 100 is down by 1.2%, as is the CAC 40. And actually, Tom, energy stocks now in negative territory. So we started with that as the only positive, and now they are at least flat, if not just into the, well, flirting with the flat line, let's say.
Let's focus in on the banking space right now. The Bloomberg scoop around HSBC, learning Bloomberg that HSBC is considering cutting roughly 20,000 jobs, which would account for about 10% of its global workforce in the coming years. The cuts will target back office and service centre roles as CEO George El-Hedary bets on AI to handle more tasks. Let's bring in Tom Metcalf, who leads our EMEA finance and investing coverage. Tom, what do we know about these plans then?
Yeah, I mean, under consideration and over the medium terms, we're talking, a few years. For me, the most interesting thing is lots of Wall Street executives have been touting, the efficiencies to be gained from AI, and this is kind of the first tangible sign of what maybe shape that might take, right? And certainly makes a lot of sense. It's those repetitive tasks that, HSBC has big global service centres around the world, and they're trying to look for ways, hey, maybe we can reduce the headcount. And then I think the quantum's interesting as well, like 10%, significant amount, but does go to show, it's not like in one go AI is going to completely transform the workforces of finance. It's multi-stage, multi-year, and of course very early stage at HSBC.
Yeah, and these are really complex and regulated businesses, aren't they? Which means, of course, there's going to be plenty of opportunity for AI like everywhere else, but it's going to have to be done really carefully. I mean, how does this fit with what else we're seeing from this? I mean, still relatively, do we still say relatively new CEO, Tom? I mean, he's been there a little while now.
Yeah, no, he joined in September 2024, but no, absolutely, his tenure has been marked by kind of like a radical restructure, and I would describe it as. And yeah, this is probably just one element. So directionally, this is absolutely what George El-Hedary, the CEO, has been saying all along, is I'm looking to reshape this bank. We're a big global bank, but, it doesn't mean we need to be kind of baggy. They've got something like 100,000 jobs. So it's a big old enterprise, and obviously there's, in his view at least, ways they can kind of shrink it and continue to deliver the service.
And Tom, you mentioned other Wall Street executives and their AI plans. How does this fit into what you're seeing? How broadly are the bosses of banks embracing AI? How broadly are they looking to reshape their workforces as a result of some of these technologies?
Yeah, I think this is the first clearest indication. But, behind the scenes, I imagine most people will be reading this going, yeah, that sort of chimes with, certainly is what I kind of would make sense to me and what I think most people in the industry are probably
expecting. You don't think HSBC is an outlier then?
No, I don't think so. And, as the time goes on and more clarity gets around this technology, I suspect you'll certainly see more announcements. I mean, look, Morgan Stanley's come out already saying it's cutting 3% of jobs. That's a fairly common thing a lot of those lenders do, but some of that will be AI driven, and I suspect we'll probably see plenty more of these, at least think-ins and discussions going forward.
Tom, thank you very much. Being based on Metcalf with the latest on the banking sector. Let's go to the oil story. Still dominating headlines from the Middle East, of course. Oil prices higher and European gas prices jumping more than 20% just this morning after attacks on major energy facilities in the Middle East, marking a significant escalation of the ongoing conflict. Iran carried out attacks on an LNG site in Qatar following Israel's strikes on the Islamic Republic's giant South Pars gas field. Anthony DePaola is our Middle East energy reporter, joins us from Dubai. Let's focus in on the gas story first, shall we? What damage then do we know has been done, Anthony, to the Qatari installations?
Good morning. Yeah, that's right. The Qatar's Ras Laffan area was hit last night, and that's a huge area which has multiple LNG export trains. So these are the facilities, lots of pipes, lots of high-pressure towers where they take the gas, natural gas extracted from Qatar's biggest offshore field in the world for natural gas. They take that gas, compress it, and cool it down so that it can be turned liquid and then put on ships. So those are highly complex facilities, very susceptible to damage if any of those pipes or pressure units are damaged. They also have there the Pearl GTL plant, which is a plant run by Shell. At the time when that was built over a decade ago, that was the single biggest investment in Qatar's energy industry by one company at one time. That was sustained severe damage, according to Qatar Energy, the state company, and as well as Shell, which has just said it's assessing damage at the facility. So we have some damage at various facilities there between the LNG as well as the gas. Of course, that field, the Qatar's North Field, is the Qatari side of what Iran calls South Pars. So that is the world's largest field, and that was what was attacked by Israeli military yesterday, and that sparked the retaliation by Qatar on the gas field and on U.S. interests as well. Of course, ExxonMobil is one of the U.S. companies that's a big shareholder in some of those facilities in Qatar. In fact, Qatar Energy even named one of their biggest LNG carriers after Rex Tillerson, the former Exxon CEO and former U.S. Secretary of State.
Anthony, can you help us explain what's happening in terms of the spread widening, the gapping that we're seeing in terms of prices between Brent and WTI?
Yeah, of course, the gas prices are shooting up on this, not because any fuel is getting out of the Persian Gulf. Of course, the Strait of Hormuz remains closed, largely closed. There are some Iranian vessels getting through, and the Iranians have let some vessels go to other countries. But things like LNG are not getting through the Persian Gulf, so they're not being exported to markets. But what traders are really watching here are the prospects for a quick startup for Gulf energy facilities should the Strait of Hormuz be opened. That's been a major focus of the military campaign, of politicians talking about when they can get Hormuz open and how they can get it open. But if we're seeing damage to facilities there, that's going to mean repairs. That's going to mean facilities out for longer periods of time. And that's really what's influencing those prices as traders see some damage come through. They are seeing a longer outage there because of damage. And it still remains unclear when Hormuz would even open anyway. So we're still in very unclear waters here.
Bloomberg's energy reporter, Anthony DePaola. Anthony, thank you for that update. Of course, in the energy space, again, European gas prices up more than 22% so far in today's session. Coming up, the S&P is delivering a rate decision in a few minutes. We're going to break it next. This is Bloomberg.
Good morning, everybody. Welcome back. This is the opening trade. 30 minutes then into our session, and things looking pretty negative across these European equity markets. The Xetra DAX was down by 2%, now just shy of 2% lower on the day. Some negativity then around these markets on the back of higher energy prices, oil and gas shooting higher. Gas certainly shooting higher by 20%, more than 20% in just this morning's session. All of this, of course, because of the huge amount of kinetic activity in the Gulf, now directed, it seems, Tom, towards energy infrastructure. that is not just weighing on risk appetite, it's even weighing on energy stocks this morning. They're not quite the cushion that they have been. What do you see in terms of the movers under the hood?
Yeah, so far just 36 companies in the Stock 600 in positive territory. On the downside, 560 then selling off in today's session on that energy crisis that continues, of course, to reverberate through these markets. Volumes currently down about 8% versus a 20-day average. That compares to a bigger drop in volumes yesterday. Let's flip the board and have a look in terms of how this breaks down in terms of the leaders versus the laggards. Not unsurprisingly, amongst the leaders, it is the energy giants. As a sector, you're seeing energy off. But in terms of some of the individual names, you are seeing a bit of a lift for the likes of BP, up 1.6%, as Brent jumps, 5-6%. Gas prices up, as Anna was saying, up 22%. Equinor then gaining 5.6%. It has exposure, of course, Equinor, to the gas space. Rheinmetall in defence getting a bit of a lift, up 0.3%. On the downside, let's flip the board. Interestingly, in the semiconductor space and that supplier of kit and equipment, ASML is down 2%, despite the fact that you've had pledges of more capex spend from Micron and Samsung through this year. Siemens down 3%, has that exposure to data centers, but also supply chain constraints as well, potentially a headwind for Siemens, down 7 points or 3%. HSBC, Bloomberg reporting they're looking at potentially cutting up to 10% of their workforce over a period of time as they embed AI. That stock currently down 1.7%. Anna.
Tom, let's focus in on some of the other stories we're covering this morning. Sticking with the tech theme, in fact, Samsung plans to spend more than $73 billion on capital expenditure and research this year. The company says the investment will go towards securing its leadership in AI technology and shifting production to address the historic shortage of conventional memory chips. European gas and Brent crude are surging this morning after Iran and Israel traded strikes on key energy facilities in the Middle East. President Trump responded by pressing for a de-escalation of attacks on energy sites in the region. Fed Chair Jay Powell says the Middle East conflict has added fresh uncertainty to the inflation outlook, adding that the US central bank won't cut interest rates again until inflation resumes cooling. Tom.
Talking of central banks, Sweden's central bank, the Riksbank, coming through with a decision as expected to hold its policy rate at 1.75%. Again, as expected, the Riksbank rate will remain at this level for some time, the Riksbank says. And in terms of the currency, I'm looking at the euro and krona cross, and you're seeing a little bit of a move lower in terms of the euro versus the krona. So the krona getting a bit of a lift, up 0.2%. The Riksbank saying underlying inflation has been unexpectedly low. The Riksbank saying that Swedish conditions are favourable for recovery. But again, the redhead across the terminals, they hold rates at 175, is that the Riksbank rates will remain at this level for some time.
So a bit of guidance there. The SNB in focus as well. And the focus here, not so much on the policy rate, on the currency, and we pulled up the Swiss franc so you can see what it's doing as I read out these headlines, but the SNB policy rate staying at 0. So that was the expectation. We'd get no change. We would not see the SNB drop into negative territory in terms of its interest rates. And of course, it's now wrestling with war in the Middle East, just like all of the other central banks around the world. They are saying on the currency they're prepared to intervene in the currency markets if needed. Excessive franc appreciation would jeopardise price stability. Let's get some analysis on what's happening with these global central banks. Jana Randau joins us live from Frankfurt. She's across the ECB, but also across the SNB for us. Jana, good to have you with us on the programme. So no change from the SNB, but they have made these comments on FX, prepared to intervene in currency markets if needed. Excessive franc rise would jeopardise price stability. That seems to be where their head is at, thinking about the FX.
Yeah, so the SNB is in a very difficult situation. Of course, policy rates are at 0. The experience they had in the past with negative rates, wasn't so great. So the policymakers are reluctant to go there if they can help it. And of course, for Switzerland, the Iran war is all about the currency. The franc is a haven, so it's appreciated quite a bit since the war started. That, of course, puts downside risks or downside pressure on inflation at a time when inflation is already closer to 0 than to 2%. And that's exactly what we saw from the SNB statement. Inflation, they said, would be higher in the very short term. That's, of course, because of oil. But then in the medium term, inflation pressure is slightly lower than previously expected. And that is because of the currency. And as expected, policymakers said they have an increased willingness to intervene on behalf of the franc to make sure that they don't need to go where they don't want to go on interest rates, and that is below zero.
And of course, a different story for the euro, which has been under pressure as a result of these higher energy costs. And Jana, you have been a long-time tea leaf reader at the ECB. You're standing there in Frankfurt for us. What are you going to be watching for, Jana, when it comes to the ECB decision and what we hear from Christine Lagarde?
Yeah, so in the run-up to the meeting, she said the ECB wasn't going to rush into decisions, and that's what we've seen, of course, from all the central banks that have decided yesterday and today so far. So a very careful analysis, a look at the situation, a look at the impact. We are getting new forecasts. How much value they hold remains to be seen, but some scenario analysis as well that will outline, how inflation risks shape up. And then the interesting thing to watch, of course, is how Christine Lagarde explains the reaction function of the ECB. So that is how the ECB will react to certain risks playing out. This is what everybody will focus on. How high is their tolerance threshold? How much willing are they to look through those energy price spikes? We all remember 2022 when they said it was temporary, and then it wasn't, and inflation ran all the way above 10%. So those scars run deep. The president said she will spare European consumers, European businesses that experience. It's all about words at the ECB. We don't expect a reaction, but we might understand a little better how the ECB looks at the risks and how they will prepare a potential response.
OK, that's a valuable framing ahead, of course, of that decision from the ECB coming from Jana Randa on the ground for us in Frankfurt. Jana, thank you for that analysis. Meanwhile, the escalating conflict, of course, in the Middle East and the resulting energy shock is set to dominate as well the EU Leaders Summit today. Oliver Crook, Bloomberg's chief Europe correspondent, joins us from Brussels. Ollie, what is Europe's view right now on the conflict in the Middle East as it seems to be, again, stepping up in terms of the extent of damage that we're seeing, particularly when it comes to energy infrastructure? Where does Europe stand at this point?
Yeah, this was a summit that was supposed to be about competitiveness, which is the big agenda item for the European Union for the last sort of year and a half, and has been put on hold perennially by all of the different activity from the United States, whether it's a trade war, whether it's the Greenland sort of a moment, and now, of course, the war in Iran, which has direct consequences and obviously also trickle-down consequences. In terms of the direct consequences, you have fairly universal consensus here in Europe among European leaders that basically there is no place in the active military part of this war for Europe at all. That is not a place for NATO, it is not a place for the EU, and that they're going to stay away from it. That has obviously prompted a lot of criticism from the United States and Donald Trump, who even yesterday was talking about getting allies to step up and potentially relinquishing responsibility for the Hormuz Strait after the war is over to the allied countries. He used sort of sneer quotes on that to take responsibility of it for those who use it. And of course now for EU leaders, this is their first moment to get together since the war began. We've just been seeing Micheál Martin, the Taoiseach of Ireland, walking in. That is obviously a relevant person because he's one of the people who's most recently sat down with Donald Trump to sort of brief. And again, we're watching very closely what the collective language from the Europeans is going to be. It's sort of interesting when you look at the European continent. Those most far to the east have been most on board with this idea of potentially NATO entering into the Straits of Hormuz. You heard that from the Baltic states. You have France taking a much more measured approach, saying there is no really place for them militarily right now, but potentially in the future to help safe passages of ships. And of course, the Spanish, we're expecting Pedro Sanchez to walk in any moment now, who has been very outspoken since the very beginning of this war, calling it illegal.
Yeah, absolutely. We'll focus on what he has to say then, and bearing in mind that geography. In terms of the economic impact then, Ollie, of the higher energy prices, oil and gas, what are we expecting European leaders to pledge on that front? They did quite a bit. Different countries did different things in 2022, but the fiscal story has evolved since then.
Yeah, absolutely, Anna. So at the moment, the sort of main responsibility has been really at the member state level. You've seen a number of different countries within Europe taking specific actions. You've seen energy price caps in a couple of countries, in Hungary, in Croatia. The Germans have taken some activity in terms of limiting the number of times a day you can set gas prices and these sorts of things. So that will fall within the member state level. What is going to happen potentially at the European level, and this is going to be very actively debated today, is tweaks that can be made to the ETS, the emissions trading system. This is effectively the carbon market that exists within Europe. It basically dictates the price of carbon from emissions for industrial companies, and as a consequence will be very sort of impactful in terms of what those companies need to charge. So there's a big debate. The Italians want to put the whole ETS on pause. Others are saying that it's very important. It needs a little bit of tinkering, but effectively this will be the conversation today among European leaders at the European level to try to bring down those prices. There are of course other ideas that can be discussed. You'll remember in 2022 there were talks about the EU level of gas price caps. Just the talks of those brought the gas prices down. They never had to be implemented, but that's a way in which potentially job owning can bring down energy prices in Europe.
Ollie, thanks very much. Oliver Crook, Bloomberg TV's chief Europe correspondent in Brussels for us as those leaders gather. Coming up on the programme, we will talk economics, we will talk the impact of war in the Middle East, and we'll talk about AI. Philippe Arion will be with the team, co-winner of the 2025 Nobel Prize for Economics. He joins Francine exclusively from the Bank of America conference in Paris. More insight on his research, diving into innovation-driven economic growth. That sounds useful at this time. That's next. This is Bloomberg. Welcome back. This is the opening trade. Now, analysts are, of course, warning that the current rise in oil and gas prices and destruction of Middle East energy infrastructure will have a longer-term effect on inflation, reminiscent, perhaps, of the oil shock of the 1970s and its impact on the global economy. Perhaps it's too soon to say exactly how big that parallel with the 70s will be. Bloomberg's Francine Lacqua is at the Bank of America Investor Summit in Paris with more. Good morning, Fran.
Good morning, Anna. Now, joining us now is Philippe Arion. He's a 2025 Nobel Prize winner in economics co-head. So thank you so much, Mr. Arion, for joining us. Look, the world seems to have changed, and this is partly because of the war with Iran. This is also trade, tariffs, and the fragmentation almost of everything. How do you see economics changing because of that?
I think it's true that we are not in the, we are beyond the full globalization phase, In the 1990s, we were all into the end of history and full globalization, value chains built on cost minimization. We would have each step of the value chain would be performed by the country where the productivity is maximal or costs are minimized. It was really cost minimization was the driving force of value chains. And nowadays, resilience is becoming much more a driving force of value chain. You want to make sure that you deal with countries that will not turn their back on you, and that you have supply assurance becomes a big, consideration to bear in mind when you build up value chains. So you are very much into Mark Carney's speech in Davos. He tells you exactly what to do. Countries that believe they share some values, democracy, rule of law, need to get together, and also you have to make sure you deal with countries. I mean, some of them, they have terres rares, they have the scarce land, or others, they have different type of technologies, but they share the same values, and they should get together because they know they can rely on each other on the long term.
Your Nobel Prize, and congratulations for that, it was only in 2025, was basically creative destruction. The idea that because of technology and things like that, things will be, because of technology, things will change. How does this extra layer of uncertainty do with how you look at economics longer term?
But uncertainty is never a good thing when you are into innovation. I mean, innovation is by nature uncertain, but you don't want to have extra uncertainty. So any extra source of uncertainty is not, conducive to innovation. Innovators need to think long term. You see what I mean? I think they need a stable environment. We need fiscal certainty. We need stability. You know, I mean, instability is not conducive to long-term innovation. But we have to do with what we have. And still, there is some globalization. It's not the same as before. I think there is one good aspect to this, is that Europe now realizes it has to innovate more. I think Europe has been the kind of sleeping beauty over the past 30, 40 years. You see, they thought they could rely on the US, on others, and not, invest heavily in breakthrough high-tech innovation. And now the European and defense, and now the Europeans realize, I hope, that they need to rely on themselves more than in the past, and they need to, to reverse this technological decline they've been experiencing.
But with oil prices up $20, $30, with LNG prices up 20, 30%, does that completely change the way that you see innovation and technology? Because people will be distracted or will be dealing with the crisis at hand.
You see, I think the Hormuz, to have the blockage of Hormuz is not great, and to have the rise in oil price is not a great thing. I don't think it will lead to disaster. I think what it will lead to is a kind of a slight increase in inflation by maybe 0.4%, whatever, and a slight growth slowdown, but not dramatic. So it's not, of course, I'd better not have the rise in oil price, but I don't think it will have, I don't see dramatic effects. It's not that it will precipitate us in another global financial crisis in the next months. I don't see that. I see a limited slowdown and a limited rise in inflation.
I mean, given the models for which you won, of course, a Nobel Prize, where do you see Europe on the technological phase?
But the thing is that Europe is stuck in midterm incremental innovation. It's not doing enough breakthrough high-tech innovation. We don't have and why is that? That's the Draghi report, the Letta report. We don't have a true single market for goods and services. We don't have an integrated capital market. We don't have enough long-term funding of research. To do breakthrough innovation, you need to fail. You need to be able to fail. To be able to need risk-taking. And long-term research finance is important if you want researchers to take risk. We need more venture capital to have startups take risk, and we need more institutional investors. We don't have enough of those. That's the ecosystem that we need to put in place in Europe.
Philippe Aghion, thank you so much for joining us. That was, of course, the 2025 Nobel Prize in Economics co-winner, professor also at the Collège de France and INSEAD. And with that, Anne, I'm going to send it back to you in London, and we'll have plenty more throughout the day here from Bank of America.
Francine, thank you. Bloomberg's Francine Lacroix, of course, on the ground for us. Let's not lose track of what's happening in the energy markets. Fran was talking about that a lot, about the higher oil and gas prices. We continue to witness Brent prices going substantially higher this morning, up by 8.8% on Brent. WTI, interestingly, only up by 1.4%. Is the market thinking that the US will be able to protect itself more from what is going on globally in energy markets? Gas prices up by 24% as well in just one day. Let's get to the source. Let's get to what has been driving those moves higher. Jumana Basekci is with us from Dubai, where, Jumana, we've seen considerable disruption to, in particular, gas infrastructure.
That's right, Anna. And the energy market's really reflecting the intensification once again of this war. It's day 20 now of the Iran war. And yesterday, major development in that Israel launched these airstrikes on that gas field, a major Iranian gas field known as South Pars. In retaliation, Iran said that GCC energy infrastructure would become legitimate targets. And indeed, that is what transpired over the course of the evening. Multiple projectiles being fired at various Gulf countries, refineries in Kuwait, oil gas fields in the UAE. But the big one being their successful targeting of the major LNG facility in Qatar, that is the Ras Laffan facility. see one of the largest LNG export hub in the world, accounting for about 20% of the global supply of LNG. So no wonder you're seeing a reaction of markets today. But Qatar Energy put out a statement saying that the damage was actually extensive. And this is the difference between the attempted strike earlier on in the war versus what's happening now. The market has to account for the fact that not only is Iran going after upstream facilities now, but they're also managing to level damage. So we've moved on from the threat of damage to actually pricing in physical destruction and not just prolonged disruption with the closure of the Strait of Hormuz. So we have most definitely entered into a new paradigm in this war, with both sides not seeing really any inclination to de-intensify.
Okay, a new phase in this conflict. Jumana Pasechi on the ground for us live, of course, out of Dubai. Jumana, thank you for that update. For a broader take on these markets then, let's bring in Morwenna Konyan, Bloomberg Markets Today editor. Morwenna, we're looking, of course, at the impacts that the energy shock is having in terms of inflation and how central bank governors are thinking about this and central bank officials. We have the BOE, which is coming up, of course. Gilts are selling off pretty aggressively in the session today. It seems like traders are looking for a more hawkish response from the BOE. What are you looking for?
Well, yeah, we will be looking very closely to see what they say about that inflationary risk. Previously, there's been some indication that perhaps they can look through it slightly. Is this short term? But obviously, the longer that the conflict goes on and shows no sign of de-escalating, the more embedded those risks become. What we're seeing this morning is, those oil and gas prices shooting up once more, and traders have been adding quite aggressively to their bets on chances of an interest rate hike from the central bank as soon as the summer, July, with that more than fully priced in, certainly by the end of the year. And that's such a sharp reversal from what we had a few weeks ago. But even, at the close of yesterday, we only had about a 50% chance of seeing one this year. So quite a dramatic change there. And that is being seen filtering across the bond market at the moment. Sort of shorter dated gilts yields up about 12, 13 basis points, which is quite a lot more than in Europe, where we're also seeing expectations for hikes ramping up too.
And so the Bank of England focuses on inflation. It's got that mandate, but it keeps one eye on jobs. And the jobs story is a bit confused, isn't it? With the unemployment rate above 5%. So a lot of people have been bracing for negative news flow surrounding the labour market. But this morning we get data that showed actually job creation wasn't so bad in the last month.
No, the job market data was actually, a bit softer than expected. It did sort of show a bit of a weakening, but actually the sort of longer-term picture perhaps was a bit more positive. Unfortunately, really that is being overshadowed because that jobs data really points to January. It feels an incredibly long time ago now. It would anyway, but I think particularly we had a lot of economic data in February, which changed the picture. People were expecting rate cuts as soon as today, and now we're looking at the prospect of a hike as soon as the summer. So I think a lot of that data is a bit anachronistic. It shows that things were looking up a bit in the labour market. It was certainly the inflationary pressures as well, with wage increases, the pace coming down as was expected. So that should have all been supporting the Bank of England's case for rate cuts. But I think in the context, it's not so much today.
January, a long time ago. Markets have quickly then, Tom, been repricing hikes here in Europe, and we're looking ahead to those central bank decisions. We're also looking ahead to more from that conference in Paris with Francine. All of the guests will be weighing in from the Bank of America Paris conference. We'll be thinking about higher energy prices, higher oil, gas prices. That's certainly the dominant theme this morning.
Gas up 25% in Europe. Oil prices up about 8% on Brent. You're seeing US futures pointing lower by 0.3%, and the sell-off here across European equities down 1.8%. These are the guests to think about then across the next hour for further commentary and insights on another significant day for these global markets. That is it for the opening trade. The Pulse is up next. This is Bloomberg.